Attorney Laura Anthony, founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is the continuation in a LawCast series talking about the NASDAQ listing requirements, and in particular, today I'm going to talk about the seasoning rule. The seasoning rule was adopted in late 2011 by multiple national exchanges, including NASDAQ, in response to a request from the SEC for the exchanges to limit the ability of companies to uplist following the completion of a reverse merger with a U.S. public shell. The SEC request came as a result of a slew of reverse mergers from China, where the representations related to the financial condition of the foreign companies turned out to be fraudulent. The seasoning rule prohibits a company that has completed a reverse merger with a U.S. public shell from applying to list until the combined entity has traded in the U.S. over-the-counter market, on another national exchange, or on a regulated foreign exchange for at least 1 year following the filing of all required information about the reverse merger transaction, including audited financial statements. The rules require that the new reverse merger company has filed all of its required reports for the 1 year period with the SEC, including at least one annual report on Form 10-K. The seasoning rule requires that the reverse merger company maintain a closing stock price equal to the stock price requirement applicable to the initial listing standard for a sustained period of time, but in no event less than 30 of the most recent 60 trading days prior to the filing of the initial application. The rule includes an exception for companies that complete a firm commitment underwritten offering resulting in net proceeds to the company of at least $40 million. In addition to the specific additional listing requirements contained in the new rule and the seasoning rule, the exchange may, in its discretion, impose more stringent requirements for companies applying after a reverse merger if it believes it is warranted based on, among other things, an inactive trading market in the reverse merger company's securities, the existence of a low number of publicly held, freely tradable securities, if the reverse merger company has not had a Securities Act registration statement or other filing subjected to a comprehensive review by the SEC, or if the reverse merger company has disclosed that it has material weaknesses in its internal controls and has not yet implemented appropriate corrective action plans. Although the rule only refers to reverse mergers with a shell company and not an existing operating business, in my experience, NASDAQ will take the position that almost all reverse mergers are completed with a shell company. Even if a company has taken the position that it was not a shell, and even if that position was not challenged by the SEC, FINRA, or any other regulator, NASDAQ can and will make its own review and determination on that point. I'm Securities Attorney Laura Anthony, founding partner of Legal and Compliance and producer of LawCast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.